Welcome to the Money Watch Show. It's Saturday, March 1st. Oh my gosh, we're back to weekends. I'm Jill Schlesinger, CFP, CBS News business analyst, and I'm joined by my co-host, Mark Talercio, also a certified financial planner. Here we are, Mark. I gave you the weekends off, and now we're back to weekends. What do you think of that?
Yes, back on the weekends, but at least we didn't actually add 2 new shows. We just moving things around.
We're moving things around. If you're listening to this and you've been listening to Money Watch for a while, you probably know we have another show called Jill on Money, which broadcasts Monday through Friday. Now we're shifting the Money Watch show to the weekends because we really believe that we've got a new mission here. We realize there's so many people who listen to the Jill on Money show, Mark, and it does kind of start to feel like these people are wealthier and more financially savvy than we ever understood. Do you agree with that?
Jill on Money audience is a very sophisticated audience.
Yes. And I feel like maybe some of you might feel a little bit like, this is a little bit too much for me. And so we are refocusing our Money Watch podcast in order to provide you with the essential building blocks for anyone, but mostly for you listening, that you want to take control of your financial lives. And we're still going to be putting our listeners into the show. We're still going to be using some of my pieces that come out of CBS News. We're still going to provide you with guidance. I really want to make sure that you understand that you can enhance your financial knowledge, and you can do so from unbiased, seasoned professionals like me and Mark, not some TikTok finfluencer poser. Did you like how I put that into the description, Mark? Finfluencer poser. Making friends always. So are you excited about this, Mark? I'm kind of psyched.
I think the world needs 7 days of Jill. Yes.
All right, calm down with that. The world needs is a way to help them take control of their financial lives, just in a way that there's no judgment. That's the other thing. This is something that you and I have always shared, Mark, that we've never felt like people needed a finger wagging. And we also know that, I make fun of finfluencers. There's a lot of good people who provide financial advice. I just think that sometimes when it's this very, very, very young person who has no experience, that they are kind of trotting out these rules that they don't understand the application in the real world. So we've interviewed some of them, right, Mark? Don't mention names.
No names mentioned, but yeah, we have. I mean, personally, that stuff, it kind of drives me nuts. I worked hard to earn my CFP credential, and I put in a lot of time to earn it. And I feel like it gives me some credibility. Just like when I started in journalism, I went to journalism school, when I got into it, that's what you had to do. Nowadays with social media and all these different outlets, kind of gets lost in the shuffle.
Yeah, it does. And so if you need some assistance, some guidance, then all you have to do is go to our website, jillonmoney.com, click the contact us button. If you want to join us live, check the box. Mark will do everything else. And if you're listening to this and you just, you feel like you've got someone in your life who could really be helped by beginning the process of building those financial blocks, and you just pass our name along, tell people to subscribe to us. And you know what we're going to do? We're going to actually start our first Saturday broadcast for the Money Watch show with a segment that I was able to do last week about investing. The anchors are Jerika Duncan and Vladimir Duthiers on CBS Mornings. And I think I called it Investing 101. So let's air that segment. On the other side of it, Mark and I are going to come back and talk about some of the basic steps you need to have covered as you approach investing. So here we go. Investing 101 for your first Saturday drop of the Money Watch show.
A lot of people say to themselves, where do we even begin? There's a new survey from Bankrate that reveals Americans' top choice for long-term investing is the stock market, but it also shows that 21%, look at that number, say they prefer not to invest in stocks because it is intimidating. But it does not have to be, because we've got CBS News business analyst Jill
Yes.
Schlesinger here with a little investing 101, as
Yes.
Nate calls you, Dollar Dollar Jill.
Yes.
Good morning.
Good morning. I'm excited about this.
Help people who are worried about their Benjamins and where their Benjamins are going to go. Why is investing so important? Why should people be in it?
The whole point of investing is to grow your money faster than the inflation rate, right? You want your money to work hard for you. And what we know is if we look back in time, we know that stocks over the long term do tend to go up. So like the last 10 years, which, was pretty bumpy along the way with COVID and the stock market plummeted. If you put $100 into the stock market 10 years ago, it grew to $295. That's an 11.4% annualized return. So I want you to compare 11.4% a year versus over that same time, if you put your money in the bank, maybe you got a good rate in the last couple of years, but prior to that, it was basically 0.5%. So you've got to have a long enough time horizon to weather those storms. And I want to be clear, no matter what, the moment you begin investing, there will be a storm and it's going to test you. So we always want to really underscore, don't invest unless you have at least 5, 10, 15 years. That way, those downward movements won't freak you out as much.
What about this idea of diversifying investments, and how should people go about it? Should they go to a person? Should they use an app?
So I want to go back one step. And when we talk about diversification, we're talking about asset classes, like different categories of investments, right? So stocks, which is basically the ownership in a company, that's one asset class. Bonds or fixed income, that's where you lend an organization money, they pay you back interest. Could be the government, can be a municipality, could be a company. There are commodities, like you could say, oh, I want to buy gold. There's real estate, or you can have cash. So what diversification basically is betting on is that these assets move differently over time. So when one is zigging, the other one may be zagging. So when the stock market is plummeting, you might say, hey, my bonds are doing okay. There are weird instances where everything goes down at once. That was 2022. That does not happen very often. Again, over the long term, based on your risk your risk tolerance, like how much you can stand, how much time you have before you need the money, that will determine how much you want in the risky stuff like stocks and how much you want to keep in the cash stuff or the bonds.
One of the things that was fascinating to me when I worked in finance was seeing how investors reacted when they saw those ups and downs in the market. When the market was coming down, actually people took their money out of the market. And when it was going up, that's when they started to put money in the market, which is the opposite of what you should do. So mutual funds are an attractive vehicle for people who don't really know what they're doing and are led by their emotions.
Right. So mutual funds is a pooled investment, meaning that we all put our money in, then the manager will go out and pick the stocks or the bonds or the real estate investments. Now, one type of mutual fund that's really great is called an index fund. An index fund will track a specific index. You've probably heard of the S&P 500, but there are bond indexes. What you really want to do is concentrate on index funds, especially to start, because they are the cheapest. And I love cheap. When you save money on expenses, it flows to your bottom line.
Meaning cheap that you are not paying heavy expenses in the mutual fund.
In the mutual fund, and you're not paying a manager to pick those different companies or those different holdings. Just remember, if you're starting out and you're looking at a retirement plan, sometimes there's something called a target date fund. It has a date at the end. That's not going to erase your risk. It's just an easy way to start investing. So it's targeting a date when you'll begin your retirement, and the manager will shift between stocks and bonds and cash as that date approaches.
Okay, so Mark, we're talking about investing, and the one thing that I think people do a little bit too much freaking out about is they say that I don't want to invest because I don't understand everything. You don't need a deep finance background. What you need to do is you need to make sure that you've got two of your big three covered. You really do need to have your consumer debt paid down, and you also need to have 6 to 12 months of an emergency reserve fund. Then you can just start using a retirement fund. That retirement is the third aspect of my big three that we always talk about. So again, pay down consumer and student loan debt, have 6 to 12 months of your expenses in an emergency reserve fund, and 3, use a retirement plan to the best of your ability. Mark, most retirement plans now will automatically, at least workplace plans, they'll automatically enroll you, right? And what do? They put 5 or 6% away in a target date fund?
Yeah, it's always a target date fund. They just, obviously look at your year of birth and align that to your projected retirement year, and they just enroll you in a target date fund, which, if you have no idea what's going on, that's not the worst thing in the world.
Yeah, I mean, it is managed for you. It's the asset allocation that I talked about in the segment where you put some money in stocks and some money in bonds and some money in cash. A target date fund will do that for you. Every retirement plan sponsor and every place where you would open an IRA or a Roth IRA, like the big places, like a Fidelity, like a Vanguard, like a Charles Schwab, like T. Rowe Price, these places have a lot of information on their websites, and they will help educate you as to what you should be doing. Investing means that you are willing to take the risk. Sometimes, and the way we started the segment was, hey, what if you hate risk and you just want to put money in, the bank? I really want people to be careful about this because, you may think you're taking no risk by keeping your money in the bank, but over time, you know what's going to happen? Your money is not going to earn enough to beat the rate of inflation because it just hasn't over time. So that's why we invest. We don't invest for the heck of it. And we don't even invest to get rich. You're just trying to grow your money faster than the rate of inflation.
Investing for your retirement is for the long term. This isn't a get rich quick type of thing. This isn't a, find the hot stock type of thing where you're going to get rich overnight. This is for the long term. We're talking decades and decades and decades. And, that's the beauty of compound interest.
Yeah. I mean, and that is the beauty of it. And so when you think, 10 years ago, you took $100 and now it's $295 because you threw it in an index fund, that's great, but that's 10 years. And in any of those years, you could have had a terrible sell-off that you have to endure.
I'll use myself as an example. I never made any money until, basically I was 30 years old. When I was in my 20s, I was living in Arizona, working in local market media. And the most I ever made, I think, was $28,000. So I couldn't save anything for retirement. I wasn't even using a 401k. I never used a 401k until I got to CBS, which at that point, I was just about 30 years old. So at that point in my life, I started putting money into my 401k. I had no idea what I was doing. I didn't know anything about finance.
But what did you do? Did you turn to somebody or did you turn?
Well, yeah, I turned to you. I mean, that's kind of when you entered my life, and I would come to you once a year. This was even before we started working together. I said, hey, what should I do? My point is, I started basically with zero in my 30s. I'm now in my mid 40s, almost late 40s, 46, going to be 47 this year. And my 401k, just from maxing out over the years, is basically $1 million. So it takes time, but I promise you it will work. And yes, we had a lot of downturns throughout the past almost 20 years, but over the long haul, it works.
It does work. And I mean, if you really freak out about risk, you don't have to be 100% in stocks. And, it doesn't work always. Like in any given year, you can have pretty much every asset class go down at the same time. You could have 2022 stocks and bonds were down. That doesn't happen a lot, gang. So here's what I want everyone to hear. We all begin somewhere. If you are feeling like you don't know how to start and you don't know what to do, I'm very, very clear that we can help bring you to this place where we're going methodically through the steps you need to take. And I mean everything. Like if you say, I'm a freelancer, I don't get a retirement plan. Okay, then we're going to have to walk you through the process, which is going to one of these large investment companies. And I would really be clear that the places that I'm about to name, they're not the only ones. They're the ones that I know offer basically zero cost index funds. So the T. Rowe Prices of the world, Vanguard, Schwab, Fidelity, E-Trade. I know that there are folks who are going to I like Robinhood. I'm not a fan of Robinhood. I'm not. I'll put it out there. It works for a lot of people. I just have not liked how they have made the world of investing like a casino. I don't love that feeling. Robinhood's never going to be our sponsor, Mark.
No, that would not be a good fit.
No, it would not be. It's like having some of these insurance companies that we've been very critical of. They'll come sniffing around sometimes. Hey, we're interested in sponsoring your show. I'm like, okay, go listen to the show. just go listen to some episodes. And then they come back. They say, thank you very much. We're no longer interested. Mark, what about somebody using a robo-advisor instead of just going and opening up, say, a Roth IRA at Vanguard or Fidelity?
Sure. I'm fine with that. I have no problem with that. It's not for me because I just have like having a bit more control over what my investments are and how they're allocated. You lose some of that with a robo, but I'm fine with that. No problem.
I am too. I really am. But if you have a question for either you or someone in your life who needs some elementary parts of their starting their investment career, give us a holler. Because if you listen to Jill on Money, what you hear is people saying, well, I got my start when I was 20 years old, and that's why I have all the money I have. Some people do step in it. I get it. They're lucky. But other people, it's just slogging away, putting money away every pay period and making it work. So get in touch with us. Go to our website, JillOnMoney.com, click the Contact Us button, write us a note, and let us know if you want to join us on the air live. You can also sign up for our free weekly newsletter. It comes out every Friday. What a good way to warm up for this weekend broadcast. Fantastic. Mark Talerci is the co-host, executive producer, and king of all things web here at the Money Watch and at Jill on Money podcast. We're distributed by Odyssey. We drop our episodes on Saturdays and Sundays. Do me a favor. Lift someone up. Change your work, change your wealth, change your life. Thanks for listening, and we'll talk to you tomorrow.